Hello everyone, George DeSantis here with a look at the market for the week ending Friday, December 6th, 2019. Before we go further, let's do the usual, bring up a disclaimer. I urge you to read it because it'll inform you that I'm not a licensed professional investment advisor, and therefore this is not an attempt to give any particular person investment advice. We usually review the market using the S&P as a good example of a general look at the market. And then we go on to look at some individual stocks. So let's begin by looking at a weekly chart of the S&P 500. So here's a weekly chart which we usually look at of the S&P 500. And let me crunch it up a bit so we could get a clearer look. What we can see here, insofar as moving averages are concerned, is that the 4 exponential moving average, yellow line, is above the red line, which is the 9 exponential moving average. That is above the 30 weighted moving average. And therefore, we have the shorter term moving averages above each other. And that is indicative of an uptrend. That uptrend started some time ago. We'll look at that. Well, let me take a look at it now with you. And here's why. You've heard me talk about how much I like the Williams percentile indicator with a 30 period right here. Look at this. Since January 18, when the Williams percentile indicator crossed above that minus 50 line, that magenta line, it's remained above it all year long. And what did we have? We had a nice uptrend of the S&P. We've had some whipsaws, some pullbacks. That's to be expected. But this is why I like this indicator so much. And I'm going to show you a screen later on, excuse me, that I did with TC2000 with individual stocks on this indicator. Excuse me, I was having to cough a bit. So if we look at the RSI 12 on a weekly chart, the research shows that once this RSI 12, not the standard default 14 period, but the 12, crosses above this yellow line, this 40% line, we are in a bull market, and that's exactly where we are. That's where we've been since January. Look at it right here, January, 18, 17, at about the same time that Williams crossed above the minus 50 line. We also had MACD trending up from below the zero line, which is one of those periods where you want to be accumulating or buying stocks. So those two indicators in particular on the weekly chart show us that we're in an uptrend. We've been that way for the whole year, really, with some whipsaws, with some pullbacks, The other thing, well, okay, so what I'm looking at now, insofar as the bullishness of the chart is concerned, is that moving averages saying we have a nice uptrend continuing here. The other thing is that we have MACD now trending up from above the zero line. So MACD is trending up. We saw these other indicators are bullish. These three are bullish now, including the Jerry Appel's sum of the rate of change indicator, this one here. Now, if there is any reason for caution here, we could take a look at a couple of things. First of all, we have what is called a hanging man, a candlestick that is described as a bearish hanging man. In addition to that, the parabolic is now getting pretty close to this last bar here. So it's a possibility that we see a pullback. But my take on this is that if we get a pullback at all, because of the power of this uptrend, that I don't think it will be much of a pullback. If anything, we'll come closer to what my friend Alex Elder would call consensus of value. That would be closer to this weighted moving average of 30 here, 30 WMA, or between the 9 and the 30, which is typically a buy point. So nothing serious in terms of a pullback. Let's take a look at, okay, the other thing I want to point out is the Bollinger Bands. This is 2 standard deviations, 3 standard deviations. The magenta lines are 1 standard deviation. So what happens is we've been bumping up against this 2 standard deviation line for a little while now, for a number of weeks actually. And so we might, as a result of that and a few other things we talked about, might see a bit of a pullback here, but temporary one, maybe between the 9 and the 30, if that far. So here's a daily chart now of the S&P 500. Let's open it up so we could see more clearly. What we have here is, again, we look at the 4 EMA, the 9 EMA, and the 30 weighted moving average. You can see that we had this slight correction here. We pulled back to 1 standard deviation below the mean price, and we found support there. We got a bit of almost a hammer type candlestick, and since then we had 3 nice days trading up. Okay, now we have the parabolic falling below the most recent bar again, which is bullish. The parabolic is described as parabolic stop and reverse indicator. So it says, look, whatever was happening before, you stop and you do the opposite. So if it was a downtrend, now you stop and it's an uptrend. We have a bar for Friday that closed between the 1 and the 2 standard deviation lines, this magenta line and the green line. And so, as I mentioned on the weekly chart, it's quite possible we see a minor pullback. But everything else is looking so bullish. You see the 4 crossing above the 9 here again, and the parabolic is below the most recent bar. So it's looking so bullish on both charts, daily and weekly, that I think we might get a very temporary and minor pullback. We're pretty far away from 3 standard deviations, and it rarely ever gets there. You could see that. Probability of price hitting that is very low. The other indicators are bullish. Formula, the sum of the rate of change is just crossed back above 4 again. And you can see that Williams percent continues to remain above that minus 50 line, and so too the RSI 12 is above 40. So that's insofar as the S&P on these daily charts are concerned. I'd like to show you one other thing, and that is the Ishimoku chart of the S&P 500. Here's a weekly chart. You can see what we were looking at before this hanging man, but all in all, Ishimoku is predicting higher prices here for the S&P. And notice that Friday was a nice volume, an up market on nice volume. So this is looking pretty bullish still. I mentioned a little earlier that I do a screen on TC2000 using Williams percentile and a few other indicators. Let me show you the conditions. Williams percentile 30 crossing up above the minus 50 line, price history above the 50-day moving average, exponential average 4 moving above the 9, crossing above the 9, and stocks are at least $10 a share and greater, and volume of at least 500,000 shares a day. And so when we do the scan on that, we end up on Friday with these 3. I looked at them. I'm not saying that I rush out and buy any of these stocks. It's just a way to look for stocks that I can add to my watch list. So if you take a look at this, you'll see that PDX right now, you can see that Williams percentile just crossed above, the 4 just crossed above the 9, etc. So it's early, and it doesn't mean that these stocks are going to continue to gain a whole lot of money, a whole lot in terms of their prices. But I just want to point it out to you. If anybody wants to do a back testing on it, you could do that. But here are some of the stocks that have done so since November, and a few of them you might recognize. For example, let's go up to the top. Might recognize, let's see, Target. I own that one, up 13% since it crossed in that manner. RH, Restoration Hardware, 28%, NTNX, 19%, etc. So if anyone wants to do a back testing of this, These are up 21%, 13%, 14%. There are losers, so you have to be careful. You don't just rush out and buy them, you know. You take a look at some other indications. So here, that's that screen that I wanted to show you. Here's you got this company, I think is a Chinese company, restaurant. Oh, it's coffee. The Chinese coffee company like Starbucks. And that one is up 37% since it met the criteria. So that's what I wanted to show you on that score. Because these videos only last 15 minutes, a little rush for time if I want to do everything I'd like to do today. And I haven't done this for 2 or 3 weeks now. So I'm going to do 2 videos. I'll stick with the general market in this one. And on the second video, I'll look at some individual stocks. So here's a chart of uh, stockcharts.com showing the spread between new highs and new lows, and you can see that it remains at least above the 50 and the 200-day moving averages. So that's pretty bullish in my opinion. We still see that above there. It's only when we get below zero and especially below 400 that we see this market going down. Another chart we want to look at here is this one. You can see that the S&P is now green, a green bar. And those of you familiar with the impulse indicator from Alex Ellis' work knows that when the bar is green, we are allowed to buy. It's a censoring indicator, as Alex described it. And so it tells us what we ought not to be doing rather than what we ought to do. So we ought not to be going short here because we have a green bar. Likewise, we ought not to be going long here because we have a red bar. Well, it turns out that the market went up anyway. Let's take a look at another. Here's a look at the McClellan oscillator, and you can see that it remains above the 250-day moving averages. So the oscillator is still looking pretty bullish. And here's a look at the we've seen this chart many times. The S&P, the percentage of stocks of the S&P 100 above their 200-day moving average. You can see it still remains pretty bullish, staying above that 50 and 200-day moving average. Well, let's bring this video to an end, and then what I'll do is do another one and discuss some of the stuff we see on Shaken and Best Choice, etc. So hang in there.